I've been getting a lot of questions from you viewers about CVS Health Corporation and asking me to evaluate this business. And so I thought it'd be an interesting one to do a discounted cash flow valuation for. CVS is expected to generate huge increases in free cash flows over the next few years and over the next decade. And it's an interesting business to consider. Let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so if this is your first discounted cash flow video you're watching with me, it has three sections. The section in green evaluates the company's free cash flow expectations. The section in blue evaluates the company's weighted average cost of capital, which incorporates its risk. And then the section in red breaks down the value of the business to a per share basis. So let's start with the section in green, free cash flow expectations. So CVS generated $4 billion in free cash flow in 2024. But according to the Wall Street analysts that are following CVS, they expect its free cash flow to surge over the next few years, jumping from $4 billion in 2024 all the way up to $12 billion in 2028. Now, I expect that growth rate will slow down, so I'm incorporating my own free cash flow forecast for CVS between 2028 and 2034 of 12.5%. That's half of the annual rate that it grew between 2024 and 2028, or I should say that it's expected to grow between 2024 and 2028. I'm forecasting a halving of its growth rate between 2029 and 2034. And then from 2035 onward, I'm forecasting CVS grows its long-term free cash flow at a 3% rate. Now, that assumes the company will lose market share overall over the next several decades. So when I incorporate all of their free cash flow forecasts and discount their free cash flows back to today, I get a value of operations of $179.3 billion. Keep this number in mind. That's going to be the starting point when we go to the section in red. When we get to that after, I go over the weighted average cost of capital of 9.06% for CVS. I arrive at that total by applying a 9.5% cost of debt. And if you've been watching my videos, you'll notice that this is one of the higher cost of debts for a business that I've prescribed. And it's because of the overall extra riskiness of CVS because of how much debt it holds as of this recording, over $82 billion. The cost of debt increases exponentially as you have more debt. Early debt, when you don't have too much debt, you can borrow at very, very low interest rates. But when your debt rises, the rate of interest increases exponentially. So it doesn't go from 4.25% to 4.5% for a corporation. It might go from 4.25% to 6.25%, which would be a 50% increase in the cost of debt. That's how significant it starts to become as you take on more debt, because you become a greater risk to lenders, and so they want to charge you a higher rate to compensate themselves for taking on more risk. The more debt you have, the riskier you are to default. So the cost of equity, I calculated at 7.74% utilizing the capital asset pricing model. CVS has a beta of 0.54, which is among the lower betas you'll see. The risk-free rate is 4.5%, and I've applied a 6% market risk premium. The market cap is $71 billion, and it has total debt of $82.7 billion. As a result, I'm giving them a target capital structure of 75% debt and 25% equity, even though you'll notice that the company has way more than 75% total debt. I'm applying that capital structure because that's the target. That's where I assume the company will want to get to. If a company has this level of debt, sometimes it's not their desired level of debt, but it's gotten there through certain decisions, and now it's higher than they would like it to be. So I would assume as soon as they get an opportunity, perhaps even over these next few years, if their free cash flow grows at the rate that's expected, perhaps they will use, and I suspect they will use, some of that free cash flow to pay down this debt so that they can become a lower risk and decrease their cost of debt. So now we'll get to the section in red, where I mentioned we'll start with the value of operations we calculated earlier, 179.3 billion. We need to add the company's cash balance and subtract the debt balance of 82.7 billion to arrive at the value of equity of $106 billion. But we want to know the price per share, so we're going to divide by the number of shares outstanding of 1.259 billion so that we can arrive at our intrinsic value per share of $84.40. That compares favorably to the current market price of $54.24. The intrinsic value is higher than the current market price. I typically apply a margin of safety when I'm evaluating businesses. I use a 5 to 10%, sometimes a little bit more margin of safety depending on the situation. And so even accounting for my margin of safety, it appears that CVS Health stock is undervalued compared to the current market price. But that doesn't mean I automatically take this as an indication to buy the stock. For me, I have a 6-step framework when I'm evaluating stocks, and valuation, I value at just 40% of the 100% in metrics to evaluate a business. And the discounted cash flow is one of only 2 or 3 valuation metrics I utilize when I'm evaluating a business. Okay, so valuation is only a fraction of my overall decision-making process, and the discounted cash flow is a fraction of the valuation part in my 6-step framework. So as you can imagine, I do a lot more due diligence before I make the decision to buy a stock, and this is one part of that. So I encourage you all to do the same, to do more due diligence than just watching this video and saying, oh my gosh, he calculated the intrinsic value, it's undervalued, I'm going to go out and buy right now. I wouldn't recommend that. I would recommend watching more videos, doing more analysis before making any decision on owning the stock. It's hard to make money. You don't want to separate yourself from your money so quickly when it's so hard to earn, right? At least that's my opinion. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.